Banking and social is going to be our topic today. We're going to dive in a little deeper to a project that is associated with Hedera. We actually had Mance Harmon on not too long ago. He referenced it. We wanted to dive in a little deeper. I think you guys are going to like it. My name is Paul Barrow. Welcome back into Tech Path. I'm just back off of a big event. We had a chance to actually go out and speak with some industry players in various industries about blockchain. So I'm back in studio. We'll dive in deep. I do want to thank our sponsor on this one, and that is, of course, Tangem. If you're looking at long-term holding and you want to do it in a way that is self-custody, Tangem is one of the best places to check out. It is a card device, and it works with an app, very easy to use. If you're brand new to crypto, this is probably the wallet for you to do self-custody, meaning you can take your Bitcoin, your Ethereum, whatever it might have, off exchanges and put it on a card, and then secure that very easily with your own phone, app, and the card itself. All you have to do is go to tangem.com, hit that little Get Tangem button. It's going to give you a 3-card set, and you can kind of go from there. Use our discount code. It helps the channel. All right, so there's a couple things that we've been talking about, and one of them has been the issue of banks and the debanking phase that the industry has been going through for some time. This, of course, was talking about Juno. Juno also, this is a tweet from that was talking with David Marcus all the way back in April of this year. But Juno was one of those banks that had a little bit of, I think, possibility. And of course, we saw it in itself also run into the challenges that many banks have been running into, and that is being able to bank inside a crypto ecosystem. So with that being said, I want to jump to this tweet right here. This is BankSocial. They're just getting started, 10,000 wallets and going. So we thought, well, let's get the BankSocial guys on and dive in a little deeper. So I want to welcome John Wingate coming over from BankSocial. Great to have you, John.
Great to be on, Paul. Thanks so much.
So a lot happening in the banking space right now. When you look at just the capacity of what many companies, businesses, et cetera, whether you're in crypto or not, maybe you're using crypto more often, this is becoming more and more of an issue overall. What is, first of all, just kind of give us a little bit about what BankSocial is first.
Yeah, so we are a financial ecosystem, generally bridging the concept of DeFi and crypto and kind of the evolution of financial systems into the regulated space of financial ecosystems. So we mostly work with credit unions and community financial institutions, and we can talk about why here in a little bit. Where we're gaining the most traction and having the most success is enabling the members, both, whether that's businesses, whether that's consumers, into utilizing crypto technologies, both, very, very candidly and, in your hand, in your face, and then even more behind the scenes, things that provide immutability to banking transactions and help regulators and, help banks be more efficient, help credit unions be more efficient with money movement. How do we bring them forward? We kind of equate banks, I don't know if you know this, but they're using technology that's 30, 45 years old.
Exactly,
there's such an
yes.
opportunity to bring them forward. So lots to talk about here for sure.
Yeah, we've seen a lot of the credit unions kind of lead the way in a lot of different financial instruments, whether it's real estate, automobile loans, et cetera, but they are very
cannabis banking.
There you go, good example, which has been one of the biggest issues out there that we've continued to see on a challenge point. And I was looking at your website, where you're available, US, Canada, not necessarily Quebec right now. And then you've got a lot of states. Let me kind of zoom in on those for our viewers right now. California, Florida, Texas, Oklahoma, Idaho, Minnesota. You guys can kind of see it. If you're listening to the podcast, jump over to the YouTube channel to check it out. So not all states, but a lot. What is holding you back from getting into all 50 states?
Well, so there's a bunch of components to our ecosystem. That's the digital asset exchange component. We do have a couple credit unions launching here pretty quickly. I think within the next 15 to 30 days that will expand the opportunity for us to serve members and serve people all across, for example, the United States, okay. And then looking at how we can do that. That's the digital asset exchange component. We really have a financial platform for money movement, a digital wallet, all the pieces, identity, all the pieces you would need to build a self-custody. I think I love what you said in the very beginning about self-custody, because we're all about self-custody. We believe that is the reason why crypto was created, not so that bank A or bank B can create a private ledger and then everybody uses that. Kind of defeats the purpose of crypto, right?
Yeah.
We're working with banks, for example, that want to tokenize loan participations. So being able to provide liquidity pools for banks to transfer money between banks that just make the whole, if only half of the equation or 20% of the equation gets more efficient, do we really benefit from that? Not really.
Yeah,
You kind of have to reimagine the whole equation, the whole ecosystem. And that's what we're doing at BankSocial.
So the involvement with the credit unions, how close is that in terms of actually working with the credit unions? Are you primarily providing technology enablement, or are you actually working more directly inside with these organizations?
Both.
Okay.
So initially, kind of our tip of the spear is we provide technology enablement. That's a very easy way to get in. We supplement, we evolutionize kind of the financial tool set available to members generally. Certainly, though, as we get more involved with our credit union partners and community banking partners, it's not just credit unions, also community banks. We are able to more fundamentally transform the way they operate. Even when you look at things like self-sovereign identity, the CFPB has recently come out and talked about how open, and Rohit Chopra of the CFPB has explicitly used the term open and decentralized. He knows what he's talking about. We know what he's talking about. Our credit union and community bank partners know what he's talking about. And it's a more open and transparent financial ecosystem that prioritizes access and ownership over centralization and silos.
Yeah. We're going to talk about Hedera in a little bit of, some of the concepts around why you guys are going that direction. I know Mance Harmon also sits, I think, on your board.
He does.
I want to learn a little bit more about that. I was looking at a tweet right here. Today, BankSocial, in collaboration with industry partners and advisors, announces the proposed DeFi Federal Credit Union, first digital native self-custody credit union powered and distributed by Ledger Technology. Explain what this is and when will it be fully approved? I know this is in a proposal state right now.
Yeah, so this is one of the original things that when I was, bridging kind of from pure DeFi into where can this live in a regulated ecosystem, right? Because I think from my perspective, at least, regulations are probably not going away. We shouldn't just throw them to the wayside, but we need to find something that provides that ownership structure where we own the rail, where we own the outcome. And in looking for that, that's how I found credit unions. And so we talked, initially we got approval on our charter, on our membership, what's called a field of membership in credit unions. That's why credit unions really don't compete, because they each focus on a field of membership or a subset group of an entire group. It's not like Chase, where Chase wants everybody in the United States to own, to be a bank at Chase. And so we started DeFi. We've since partnered with a credit union out of Virginia that is transferring their membership into supporting the DeFi Federal Credit Union membership.
Okay.
So, what they had was they have all the infrastructure. They've got all the existing kind of initial systems that are plugged into the existing rails that we can take advantage of, and then bolting on all the new systems that provide for self-custody, tokenization of a dollar, tokenization of loans, liquefying loans, things that can become so much more efficient, but that also require those existing rails. How are you going to bring money from bank A to this new banking institution? You need rails. And so we've partnered with, I can't really say the name of the credit union, but a very innovative, forward-looking CEO out of Virginia. So it started as an idea where we would build a credit union from scratch. We worked with the NCUA, who's the regulator of credit unions. They're essentially the FDIC, the Fed, and the OCC wrapped into one regulator. And they have autonomy over all credit unions. Just like the Fed has autonomy, they've got autonomy. Okay. And so we transitioned that. We saw that as an easier path and transitioned that. Certainly, though, I think it would be wrong to think that one financial, just like, do we want one crypto ecosystem? Do we want one coin to represent all of our future of finance? Probably not. We probably want, kind of more of like, hey, if I can create value with some ecosystem that I think is valuable and other people think it's valuable, it's more about the interchange of value for the future. Most credit unions are kind of like analog
DAO.
DAOs.
Yeah.
Yeah, they're kind of like analog DAOs. And so by providing this tooling set, we can allow them to all create micro economies that are interoperable with each other, which I think is what the CFPB and kind of what the future of finance really needs to be about.
So I'm on your website right here, DeFi.coop, bank yourself. So this is kind of an outline of what you guys are getting going. When do you think this will start to gain ground and really start to be something that people can really start to participate in?
This is already available. We've got 30 credit unions. I mean, if you go look through kind of our, like one of the ones who's about to launch right now, a really large credit union called CU1, they're about to launch. We've got several credit unions around the United States that we've implemented self-custody digital wallets into the digital banking app. So literally in your app, your phone app for your bank or your credit union, you can log in, buy assets in a self-custody way, sell assets in a self-custody way. We're working on some even more novel solutions that allow for payments infrastructure to be embedded right in the app. You can have one account, one digital asset account, and have that representative of all of your bank, have all your bank accounts connected into that, and liquefy, if you need to liquefy Bitcoin to pay for something, a loan, for example, right? You need to make a payment on a loan. Well, why can't you just use Bitcoin in real time to make that? Maybe you don't want to, maybe you want to stack sats, but you should have that option, or, turning your paycheck into a portion of that, like in your banking app. And we believe that owning the rails for members to own access, for example, why should you need 5 intermediaries between you and ACH or FedNow in the United States? You don't. And a credit union gives you that opportunity and that possibility.
So I'm here on the NCU site right now and just looking at the credit unions. This one, of course, is down near us, Space Coast Credit Union. So those are the kind.
Mm-hmm.
Now, obviously, if I search DeFi, it's not on there right now, but will we see DeFi show up here at some point?
Absolutely.
NCU?
So that's what's in. That's absolutely. So it's a federal charter. We're in stage 2, there's 3 stages of the chartering process. Stage 1 is you get your field of membership approved. That's basically where they tell you that your group that you're going after is specific enough to warrant a individual charter. It can't be too broad. You can't say, hey, we're going after everybody in the United States. So
you're going after crypto members, right?
Yeah. People who care about crypto, people who care about the evolution of crypto and financial kind of evolution of finance. So that's our field of membership. We got stage 2 approved, which was essentially our business package and charter member. The last stage is really honing in, and that's where we've transitioned it. Instead of whole cloth starting a credit union from scratch, there was so much more value in transitioning an existing credit union who wanted to be novel, who wanted to, kind of explore the opportunities available in this new paradigm of finance. Why not leverage that?
There's a couple of things I wanted to get on. In terms of like a regular bank, FDIC comes in and secures your deposits. Is there the same kind of thing that happens within a credit union?
Yeah, so NCUA does that. The main difference between credit unions and the banks is that banks have 3 regulators that regulate them. They've got the Fed, which is like the regulator for how you work. You've got the FDIC, which is the insurer, and then you've got the OCC, okay, the Office of the Comptroller, Currency Controller. In credit unions, you just have the NCUA. All 3 of those regulators are boiled up into the single regulator. So the NCUA, they insure, they regulate, they kind of create policy, they do it all. And so we've been working at.
What would be the equivalent? What would be the equivalent of like an FDIC insurance for if I'm a depositor?
It's exactly the same.
Same thing.
Exactly the same. $250,000. It's exactly the same.
Have you seen any innovation in the merchant services side? Because obviously businesses in many cases are tied into having to sign up with certain merchant services. That is a huge part of their fees annually that they're paying. And then you have the big struggle, which is the fees that you're paying on the tax you're collecting for the government. So there's multiple issues that are facing retailers and a lot of businesses today. Anything you see coming down the pipe on that?
Yeah, absolutely. So we are with a couple of our credit union partners working on some novel plugins to existing merchant service providers like Clover, like some of these other things where they can get banked, Stripe, things like that. So our payments hub already works really closely with Stripe and a couple of these other merchant service providers. But getting it into the form of, how do you cut out the heavy 3.5-4% fee?
Yeah.
If we do it on a crypto network, i.e., if we do it on Hedera, where the transaction fee is 0.001, and then we put as a network a very small, de minimis fee on top of that just to maintain the network, you're talking about orders of magnitude, more efficiency, more scales of cost, and they're settling in just the same amount of time. They're immutable, right? They're not maintained by one single entity. So many value, paradigms there.
For sure. Speaking of Hedera, I'm looking at a tweet from them at the intersection of blockchain and open banking. They're talking about you guys, BankSocial, the Web3 platform, kind of enabling this next generation here. Why choose Hedera? What was the kind of the genesis of going that direction?
Yeah. I'll just highlight the top three. I think there's many reasons why. The top three for us is, you have the whole concept of a validator network, a staking network, right? Who's validating the transactions with 39 Fortune 500 companies that are known, that are on the council. Governance, right? People don't think that's decentralized. I think that's decentralized. I think that's one of the better mechanisms for decentralization that you can have. The collusion resistance, the ability to, in the event that collusion happens, the ability to hold accountability towards those actors, it's unprecedented. When we look at kind of the next piece of why we chose Hedera, it's the fixed fee in dollars. If I'm a business and I'm having to contend with, dollars are doing this all day right now, right? Compared to the rest of the world, the dollar goes up, the dollar goes down. But if my fees, if the gas fees or the network fees are also doing that, and I'm having to counterbalance both of those, it's very hard to run a sustainable business model on that. And so with Hedera, we kind of get the stability of knowing what our fixed cost fees are going to be. And then the third thing that I think just generally for businesses to be fast, nimble, try use cases, try pilots, the infrastructure that was built in the form of, getting a little under the hood with technology, the SDKs, the development kits that were built, multi-language, robust development kits that within a couple hours of seeing the development kit as a developer, very clean, you can get something off the ground.
No, I understand. Those are solid arguments, and I think you're right. There are some good alignments there with what you guys' vision is. I want to go further into how banking is somewhat being transacted today. Here's David Marcus from talking about Bitcoin Lightning. And this is something that when you look at, they've been talking about this for quite some time and trying to do things with Lightspark. Do you see this as being a competition to what potentially eventually could go into traditional banks, where the conversion is actually happening outside before it actually comes into a traditional fiat bank? What are your thoughts on that?
Yes, I think that the convergence of those two systems is happening now. This is literally some of the things that we're working on with our credit union partner. Literally, our solutions are bolted directly onto the banking core. They directly touch your dollars and cents, and so there's no intermediary in the middle.
Yeah.
And because the institution is owned by you, when you put money into a credit union, you own the institution. You own the whole solution end to end.
Yeah,
that's what's exciting about it.
Not that way with traditional banks. What about Robinhood? You look at what Robinhood is trying to do. They seem to be encroaching on banking more and more. Obviously, they're a crypto exchange and a brokerage. Do you see those kinds of financial systems starting to impede or possibly compete, maybe on a third, rail of the banking system that kind of has become, whether you look at neobanks or what might be happening here in the credit union space, just your thoughts on how that might play out?
It already is impeding, and I think that's the point that we all need to understand. These are unregulated banks. So when you look at Cash App, when you look at PayPal, when you look at Robinhood, when you look at, these are unregulated banks. You don't have the same protections of an NCUA or an FDIC insured. I'm not saying that's better. I'm just saying that that's a consideration that should be had, right?
Interesting.
There's fine print. I mean, a lot of times when you see
Well,
these
how are they getting
institutions
an
fold,
FDIC? How are they getting an FDIC insurance on your deposits if that were not the case? Because they're
well,
cycling
what
that through a sister bank
a
or a
bank,
partner
right?
bank.
They're cycling it through a partner bank, a sister bank, and so the whole idea is how do we put that technology? How do we put a Robinhood self custody type of technology right in your bank so it's not a facade on top
Okay.
of another banking infrastructure that's most likely using other third-party merchant rails, and then you're only dealing with one bank. Like that's not very open, right? Like I want to be able to take my Robinhood account or my self-custody wallet, for example, and if I want that to be at my Chase account, tied into my Chase account directly, right? Not through some intermediary connectivity where I'm going to pay $15 to get it out the other side. If I want it to be tied directly to my Bank A, because most people I think have more than one financial tool. And a lot of times the reason why they get a Robinhood or a Cash App is because these institutions have been left so far behind. Technology is so expensive for them to implement. They've been left so far behind. But really the best place for that to live is at the financial institution where you're cutting out the vast majority of middlemen to get the same type of outcome. Because at the end of the day, the outcome is the outcome. The money gets into your account. The question is how much did that cost? How much risk was introduced in that equation? So I agree with you. I think that there's a massive, it's not coming, it's here. And that's what we're really working to displace is we need people working directly with institutions, multiple financial institutions, because the intermediary of a Robinhood or a Cash App doesn't provide any more stability to the system, frankly.
Yeah.
It fragments the stability.
Exactly. I want to hit on I know we're running along here. I just want to hit on a few points real quick. First thing, I'm over on your wallet, so getthewallet.com if you guys want to find the wallet right here on BankSocial. So this is available, and eventually the way this is going to work, if I want to plug my DeFi wallet on BankSocial into the Space Coast Credit Union, and utilize that, how soon would I be able to do that?
Okay, so that's already happening in several credit unions. You can already do that in several credit unions.
Is there a list of where those credit unions are? Is there a place out there where we could see that list?
So we're being a little strategic because we do have a few competitors that are in the market. What I can tell you is that here in the next probably 35 to 40 days, we're going to be doing a lot of strategic campaigning with our partner credit unions. The ability to bring in your self-custody wallet, make it portable, and also have access directly to buy, sell, liquidate, get it on a payment rail directly for the lowest absolute cost, risk, and cost is there. Like we're there.
Yeah.
Now we're just evolving those points.
All right, so I'm looking at a couple other things here. I want to look at, this is BSL. This is on Saucer Swap. This is the token side of things. Trading fees, why? Why would we see trading fees around this?
Yeah, so when we originally launched, the idea of BankSocial was the one of the components that's still there that we still heavily work on is the DAO and the lending component that we have. So we've done loans to businesses. This fee that's taken off is put in a lending pool, and then those funds are lent, and service fees, interest is all paid back by the person taking out the loan, and then those are distributed to all the token holders who stake. So that is a DeFi lending protocol that is built into that token. Again, this all happens on chain. This all happens without the facilitation of kind of human interaction. We wanted to make it a pure DeFi play, and we wanted it to be a real sustainable use case.
So you've got a tweet here. It's airdrop day. This just happened. When was August 15th? And this is all wallets captured in the BSL and HBAR, and Secura NFT snapshots will be airdropped their BSL. So that occurred. Now you've got scenarios happening within the NFTs. Big news, obviously, today was the SEC sending a Wells notice over to OpenSea. So now we've got, the true NFT market taking place on that. Within the NFTs, I mean, first of all, businesses that are starting to use blockchain and NFTs for everything from membership and loyalty and all those things, do you feel like those are going to be at risk from the SEC trying to impede on what's happening with just traders over on something like an OpenSea?
I don't. I think that there was a period of time where when the SEC started going after, and I'm not a lawyer, so take my thoughts for what they're worth. But when the SEC started going after ICOs, people pivoted very quickly to trying to repurpose the ICO framework into a NFT framework because they thought they would be safe. What we have in DREC, first ever, we're part of the DREC Alliance. It's the first ever decentralized recovery mechanism that splits your key. So in this same framework that we were talking about, we split your key up and we put it into multiple credit unions. So these credit unions host nodes, and these nodes are, it's very interesting because it's the new concept of a digital vault. It's the new, you had the old, what were they called? The safety deposit box.
Right.
This is the new version of it's a digital safety deposit box. The difference is that no one credit union, or even based on how we built the cryptography, and we worked with Dr. Lehman from Hedera and Mance on this very closely. The way the cryptography works, only you can recover the key. And the really cool part is that it almost lives on in perpetuity. When we look at the failure rate of credit unions, and we look at how many times we split up your key, multi-party computation, and the number that you need back to reconstitute your key, there's literally a mathematical equation that says you'll never lose your key. Like you never have to worry about losing your key again.
Well, that's huge,
and
because
so
that solves the biggest problem in crypto for sure, especially with new people coming in. So if you can automate that
exactly
and getting it into a position, I'm looking here at the price for zero trust key recovery. This is the DREC. What's the differences on these levels right here? Because
so
2-year,
this
1,000 wallets.
This was more of a this was more of a initial generation. So this bought like upfront. There's a little bit more included with this, but generally anybody's going to be able to get DREC for a low monthly, just a couple bucks deal, right, on an ongoing basis. The Secura tag is a what we believe is that the future. I mean, you're probably well aware that things like two-factor auth with a phone, completely hackable nowadays. I see a lot of, I'm not going to name names, but I see a lot of products that are doing email authentication for key recovery. Terrible, right?
Terrible idea.
By adding, terrible idea. You really need multi-factor, right? Like those things should not go away, but they should be supplemented with additional factors. This is an additional factor. This is a physical device that pairs with the phone, stops the phone from being able to do things that generally you wouldn't want it to do if you weren't there. So if somebody just picks
almost
up your
like
phone,
a hardware wallet,
you're not,
in essence.
It's almost like a hardware wallet, but I'm not a big fan of the hardware wallet because it still has the, well, let me not say I'm not a big fan. I think that they're great, but they still have the same Achilles heel. It's the key phrase, right? That's the Achilles heel of all this.
So why not work with some of the hardware wallet manufacturers to be able to integrate into these in the future, like a Tangem, a Ledger?
We do think that there's an opportunity to do that. This Secura tag is also a part of what we're utilizing for digital banking infrastructure security. So people being able to log in, we kind of feel like an intuitive multi-factor ecosystem of devices and, Face ID and phone numbers and emails. They all need to work cohesively in a very intuitive way. And not just for one part of the ecosystem, but for the entire ecosystem.
All right. So one last question. I actually have two. One on the idea of earning yield on stablecoin. Is that something? Because I mean, we're seeing this with Coinbase. You see this with Robinhood. Most likely, we're going to see this with stablecoin regulations, even maybe within banks soon. What are your thoughts on that?
So I think that banks are already doing this. I think what you're really just talking about is a shift to a lower cost model of doing this, right? So how do you bring in deposits? You offer yield. And a stable coin is really just backed by, so we have a stable coin called rUSD for everybody's USD. And the whole idea is that instead of it being at one institution, like a BNY Mellon, our stable coin is distributed amongst many credit unions. So it's a decentralized stable coin backed one for one. And the credit unions pay for these deposits, right? And this is something they already do. So we don't have to build a layer. Again, it's all about removing the middlemen, putting you and your financial future as close to the rail and as close to ownership of the institution as possible. while introducing these novel concepts, these novel DeFi digital assets. How do we marry the two and create this new financial paradigm going forward?
Yeah, for sure. Last question on this was crypto hard money loans. So you've got this is on your website over there. So stake and hold, crypto down payments. So using your down payments for hard money, like a construction loan in real estate.
Yeah.
How are you guys doing this? How does this work? Explain.
So essentially, we've got loans.banksocial.io. Somebody can come in, apply for a loan. It goes to the DAO. The DAO has some delegates. The delegates review based on a measure that was passed by the DAO, some rules. It's only business lending. So, we had to comply with UCC, statewide, UCC, kind of worldwide business lending. So if you do consumer lending in the United States, you come under NMLS, you come under Consumer Protection, CFPB. With business lending, there's, we even checked with places like New York early on to ensure that we were fully compliant with New York law. So business lending is what the DAO exclusively does. Again, we've got loans outstanding.
So that
those return a yield.
A UCC on the crypto that you're putting up for collateral?
It can. So the interesting thing is with working with the TBC here in Texas, TBC pioneered UCC law that allows you to perfect digital assets in a UCC filing. So before you weren't able to, isn't that interesting? So you can actually take digital assets, put them in a multi-sig wallet, for example, where both sides or multiple parties own escrow on that, and you can perfect lienable rights, first position, second position, third position, lienable rights against that. The TBC pioneered that here in Texas. Really awesome.
Okay, so I don't think that's available nationwide right now for UCC integrations like that. You're saying that's available now in Texas?
It's available in like handfuls of states, and it's actually gaining traction a lot faster than you would think. So your traditional ones that you would think, like the Wyomings, I think even Colorado, don't quote me on this, but definitely Texas, and there's handfuls. It's not just 2 or 3. There are handfuls now. Generally, though, when you have standing or precedent with another regulator, it's not hard if you get into some type of legal to utilize standing and precedent in another jurisdiction to, bring about kind of a firm, solid case for why it should be considered in your case, even if you're not in a state that recognizes it yet.
Yeah, for sure. John Wingate, founder and CEO over at BankSocial. Thank you so much for stopping in today. I learned a lot about this. So this is an exciting time, I think, for, crypto especially, but I think a lot of people, as they discover just the freedom that it brings and the ability to go in traditional banking, rails, are going to be pretty interested in this in the future. So thanks for coming in today. We appreciate it.
Thank you so much. It was a pleasure.
You bet. All right, so you guys are tuned in maybe on the podcast side of things. Jump over here to the YouTube channel, make sure and subscribe, like a couple of videos. We'll get in your feed and you'll start learning a little bit more about what's happening on blockchain technology as well as business. We go into a lot of details. And when it comes to the regulation, all that kind of stuff, we cover it here on the show. Of course, all you have to do to catch me is out there on X. Just follow me. It's @PaulBarrett. We'll catch you next time right here on TechPath.